The most expensive no in corporate history was delivered in a conference room in Santa Clara sometime in late 2006. Apple had just sent Intel a proposal: design and manufacture the processor for a new mobile device called the iPhone. The margins were below Intel's standards, the volumes were uncertain, and the mobile phone market was dominated by Nokia and feature phones that didn't need expensive chips. Intel's business was built on 60% margins selling server and PC processors, not $10 phone silicon. The executives reviewed the numbers, compared it to their core business, and declined. Apple turned to Samsung and ARM, and the entire smartphone revolution happened without Intel inside. The meeting is scheduled for late 2006 and the proposal has not been finalized. Inside Intel's executive suite in Santa Clara, Paul Otellini is reviewing a partnership offer that arrived through informal channels. Apple, a company Intel recently helped transition to x86 processors for its Mac computers, is developing a mobile device. The project is secretive, but the ask is direct. Intel should design and manufacture the processor for what Apple is calling the iPhone. The numbers are on the table, but they do not look like Intel numbers. Apple is proposing per-unit economics that fall far below Intel's standard gross margins. The volumes are uncertain. The device itself is unproven, and the mobile phone market in 2006 is dominated by Nokia, Motorola, and feature phones that do not require high-performance processors. Intel's business model is built on selling expensive chips with 60% gross margins to PC manufacturers and server customers. A phone chip, even for Apple, does not fit that model. Otellini and his team discuss the technical requirements. The chip would need to be power efficient, compact, and cheap to produce. Intel's x86 architecture, optimized for performance and backward compatibility, is not designed for battery-constrained devices. The company has some mobile experience through its exascale ARM-based processor line, but Intel sold that division to Marvell in 2006 for $600 million. A decision made because mobile chips were seen as low-margin distractions from the core business. The Apple proposal is treated as a tactical question, not a strategic one. Should Intel accept lower margins to enter a market it does not control? Or should it stay focused on the businesses that generate reliable profits and protect its architectural dominance? The decision is made quietly, and it is no. Intel declines Apple's offer. Apple turns to Samsung, which uses ARM-based processor designs, and begins developing its own chips in partnership with ARM Holdings. The iPhone launches in June 2007 without Intel inside. At the time, the decision appears rational. Intel is the most profitable semiconductor company in the world, and the PC market is still growing. The mobile phone market is fragmented, price-sensitive, and uncertain. The margins are too thin, and the risk is too high. Intel's position in 2006 is built on decades of architectural and manufacturing dominance. The company controls the x86 instruction set, the standard for personal computers and servers, and it manufactures its own chips using process technology that is consistently ahead of competitors. Intel's business model depends on high-performance processors that command premium prices, and the company's gross margins regularly exceed 60%. The PC market in 2006 is mature, but still profitable. Global PC shipments are growing at single-digit rates driven by emerging markets and replacement cycles in developed economies. Intel's core architecture, launched in 2006, restores the company's performance leadership after years of competition from AMD. The roadmap is predictable, the customer base is stable, and the financials are strong. Mobile phones, by contrast, are seen as a different category entirely. In 2006, the global mobile phone market is dominated by feature phones, devices with basic displays, physical keyboards, and limited computing power. Nokia is the market leader with more than 30% global share, followed by Motorola, Samsung, and Sony Ericsson. These devices use low-cost processors optimized for power efficiency and price, not performance. The average selling price of a mobile processor is a fraction of what Intel charges for a PC chip. The smartphone category exists but is niche. Research in Motion's BlackBerry dominates the enterprise market, and a few devices running Windows Mobile or Symbian offer limited internet and email capabilities. But smartphones represent a small percentage of total mobile phone sales. and the market is fragmented across incompatible platforms. Intel's assessment of the mobile market is shaped by this environment. The company sees mobile as a low-margin, high-volume business that does not align with its strengths. Intel's x86 architecture is powerful, but consumes more energy than ARM-based designs, making it poorly suited for battery-powered devices. The company's manufacturing facilities are optimized for high-margin products, and retooling for low-cost mobile chips would require significant capital investment. Apple's proposal challenges that logic, but only slightly. In 2006, Apple is a niche player in consumer electronics, known for the iPod and a small share of the PC market. The company has no experience in mobile phones, and its proposal for a touchscreen device without a physical keyboard seems risky. Intel's leadership does not dismiss Apple, but they do not see the iPhone as a category-defining product. The decision to decline Apple's offer is made in the context of what Intel knows and what it values. The company is optimized for performance, backward compatibility, and high gross margins. Mobile is optimized for efficiency, cost, and battery life. The two models do not overlap, and Intel chooses not to force them to. ARM Holdings, by contrast, operates on a fundamentally different business model. ARM does not manufacture chips. It licenses processor designs to semiconductor companies, which customize and produce them. ARM's architecture is designed from the ground up for power efficiency, making it ideal for battery-constrained devices. The licensing model allows ARM to scale across multiple manufacturers without capital-intensive fabs. When Apple needs a processor for the iPhone, it does not need Intel's manufacturing prowess. It needs a design that Samsung or another foundry can produce at scale. ARM provides that, and Apple begins a partnership that will define the next decade of mobile computing. Intel, meanwhile, continues to focus on PCs and servers. The company's roadmap assumes that mobile devices will remain secondary to traditional computing, and that any convergence between the two will favor x86 architecture. That assumption will not survive contact with the market. The decision to decline Apple's iPhone chip proposal is not recorded in a single memo or board resolution. It emerges from a series of internal assessments, financial models, and strategic priorities that reflect Intel's identity as a company. Otellini and his executive team evaluate the Apple opportunity using the metrics that govern Intel's capital allocation decisions: projected revenue, gross margin, strategic fit, and technical feasibility. The revenue projections for the iPhone are speculative, based on a product that does not yet exist in a market category that is not yet proven. The gross margins are far below Intel's corporate target, and accepting the project would set a precedent for lower-margin businesses that could dilute the company's overall profitability. The technical challenges are also significant. Intel's x86 processors are designed for performance, not power efficiency. Adapting the architecture for a mobile device would require substantial engineering effort, and there is no guarantee that the result would be competitive with ARM-based alternatives. Intel's Exascale division, which used ARM designs, was sold in 2006 precisely because the company saw limited strategic value in low-margin mobile processors. The decision is framed as a matter of discipline. Stay focused on the businesses where Intel has a structural advantage and avoid chasing opportunities that do not align with the company's strengths. From Intel's perspective, the decision is defensible. The company is the global leader in microprocessors, with a dominant position in PCs and servers, a world-class manufacturing operation, and a track record of sustained profitability. Saying no to a low-margin mobile project is consistent with that strategy. Apple, for its part, moves forward without Intel. The company partners with Samsung to manufacture the first iPhone processor, which uses an ARM Cortex design. The chip is produced on a 90-nanometer process, and it is optimized for battery life rather than raw performance. The iPhone launches in June 2007, and the market response exceeds Apple's internal projections. For the first year, the iPhone is a premium product with limited distribution. Sales are measured in millions, not tens of millions, and the device is constrained by exclusive carrier agreements and a high price point. The market impact is real but not yet transformational. Intel's leadership watches the launch but does not revise its strategy. The iPhone is seen as a successful niche product, not a threat to the PC ecosystem. The assumption is that smartphones will coexist with PCs, not replace them, and that Intel's dominance in computing will remain secure. That assumption begins to erode in 2008. In 2007 and early 2008, Intel's decision to decline the iPhone chip partnership does not appear to be a mistake. The company reports record revenue and profits, and its core microarchitecture restores Intel's performance leadership in the PC and server markets. The mobile phone market is growing, but it remains a separate category, and Intel's absence from it does not yet threaten the core business. The iPhone sells well, but it is not yet a mass-market device. In its first full year, 2008, Apple sells approximately 11.6 million iPhones, a strong result for a first-generation product, but a small fraction of the more than 1 billion mobile phones sold globally that year. The device is expensive, tied to exclusive carrier deals, and limited to markets where Apple has distribution agreements. Intel's leadership continues to view mobile as a secondary market. The company's roadmap is focused on advancing x86 performance, improving energy efficiency for laptops, and expanding into adjacent markets like embedded systems and consumer electronics. Intel announces Atom, a low-power x86 processor designed for netbooks and mobile internet devices in 2008. The chip is positioned as Intel's answer to ARM in battery-constrained devices, but it is not designed for smartphones. But the mobile market is moving faster than Intel anticipates. In 2008, Apple launches the App Store, and the iPhone becomes a platform, not just a device. Developers create thousands of applications, and the ecosystem begins to generate network effects that lock in users and attract new customers. The iPhone's success prompts competitors to respond, and Google launches Android, an open-source mobile operating system built on ARM architecture. By 2009, the smartphone category is no longer niche. It is the fastest-growing segment of the mobile market. Android devices proliferate across multiple manufacturers, all using ARM-based processors. Apple continues to design its own chips in partnership with ARM, and each generation improves performance and efficiency. The gap between ARM and x86 in mobile computing is widening, and Intel is on the wrong side of it. Intel attempts to enter the smartphone market with Atom processors, but the efforts are unsuccessful. The architecture is more power-hungry than ARM alternatives, and device manufacturers are reluctant to adopt x86 chips that require different software optimizations and offer no clear advantage over established ARM designs. Intel offers subsidies and co-marketing agreements to smartphone makers, but the deals do not result in significant market share. By 2010, the smartphone market is dominated by ARM-based processors, and Intel's position is marginal. The company's mobile strategy is reactive, not proactive, and the gap between Intel and the market is growing. Inside Intel, the discussion shifts from whether mobile matters to how Intel can catch up. The company increases R&D spending on mobile processors, acquires wireless technology companies, and restructures its business units to prioritize mobile. But the ecosystem has already formed around ARM, and Intel's attempts to break in face structural disadvantages. The iPhone, meanwhile, continues to grow. In 2010, Apple sells 40 million iPhones. In 2011, that number reaches 72 million. The device is no longer a premium niche product. It is a mass-market phenomenon, and its success is driving a broader shift in computing behavior. Consumers are spending more time on smartphones and less on PCs, and the applications they use are increasingly mobile-first. Intel's PC business begins to stagnate. Global PC shipments peak in 2011 and decline in subsequent years as consumers and businesses shift spending towards smartphones and tablets. The market that Intel built its empire on is contracting, and the market it declined to enter is exploding. By 2012, the strategic miscalculation is undeniable. Intel is the dominant player in a declining market, and it has no meaningful presence in the market that is growing. The company's stock price, which peaked in 2000 during the dot-com boom, has not recovered, and investors are questioning whether Intel can adapt to a mobile-first world. In 2013, Paul Otellini steps down as CEO. In interviews after his retirement, he acknowledges that declining Apple's iPhone chip proposal was a mistake, calling it a decision he regrets. But by then, the window has closed. ARM's dominance in mobile is entrenched, and Intel's efforts to compete are years behind the market. The consequences of Intel's decision unfold across more than a decade in market share losses, strategic pivots, and organizational restructuring that reshape the company. Intel's failure to enter the smartphone market at its inception means the company misses the largest growth opportunity in semiconductor history. Between 2007 and 2020, global smartphone shipments grow from fewer than 150 million units per year to more than 1.3 billion units annually. Nearly all of those devices use ARM-based processors, and Intel's share of the mobile processor market remains negligible. The financial impact is measured not only in lost revenue but in lost strategic positioning. ARM-based chips dominate not only smartphones but also tablets, wearables, and eventually laptops and servers. Apple's transition to its own ARM-based M1 processors for Mac computers in 2020 represents a direct challenge to Intel's core market, and it is made possible by the mobile processor expertise Apple developed starting with the iPhone. Intel's PC-centric business model becomes a liability as the market shifts. The company's revenue growth stagnates, and its gross margins decline as competition intensifies and demand for high-margin PC processors weakens. Intel invests billions in mobile processor development, but the efforts yield limited results. The company's Atom line fails to gain traction in smartphones, and subsequent mobile initiatives, including partnerships with device manufacturers and subsidies to encourage adoption, do not change the market dynamics. By 2016, Intel effectively exits the smartphone processor market. The company announces it will no longer develop standalone mobile processors, instead focusing on PCs, servers, and emerging markets like artificial intelligence and autonomous vehicles. The exit is framed as a strategic refocus, but it represents an admission that Intel cannot compete in mobile after a decade of trying. The broader consequences extend to Intel's competitive position in other markets. The rise of ARM-based computing challenges the assumption that x86 architecture is the inevitable standard for all computing devices. Cloud providers begin deploying ARM-based servers for workloads that prioritize energy efficiency over raw performance. Microsoft and other software companies invest in ARM compatibility, reducing the architectural lock-in that once protected Intel's dominance. Intel's manufacturing advantage, once a structural moat, also erodes. The company's process technology, which was consistently ahead of competitors for decades, begins to slip. Delays in transitioning to smaller process nodes allow competitors like TSMC and Samsung to close the gap, and by 2020, TSMC is manufacturing chips at nodes more advanced than Intel's. The loss of manufacturing leadership compounds the strategic damage from missing mobile, and Intel's market capitalization falls behind TSMC and NVIDIA. The decision made in 2006 does not destroy Intel, but it fundamentally alters the company's trajectory. Intel remains a major player in PCs and servers, but it is no longer the unchallenged leader of the semiconductor industry. The company that defined computing for 3 decades is now one of several competitors in a fragmented market, and its future growth depends on markets it does not yet dominate. The meeting in 2006 is preserved in interviews, retrospectives, and internal histories that describe a decision framed by margins and markets that no longer exist. Intel declined to build the iPhone chip, and the mobile computing market moved forward without it. The decision was rational by the metrics Intel used, and it was consistent with the company's strategy and structure. But the market did not care about consistency. It cared about efficiency, ecosystems, and the shift from desktops to pockets. By the time Intel acknowledged the mistake, the architecture of mobile computing was already set, and the company's attempts to compete were met with an installed base that measured in billions. The iPhone launched without Intel inside, and the cost of that absence is still being calculated.